right, let's talk about that feeling every investor knows. You see the market start to dip, and that big question hits you. Is this just a little turbulence, or are we heading for a real crash? Well, today, we're going to get some answers by digging into 20 years of S&P 500 history. Let's get right into it. You hear it on the news all the time, right? The market just broke a key level. But what does that actually mean for us? Is it just a blip on the radar, something we can ignore? Or is it the fire alarm telling us to get out? How in the world are you supposed to know the difference? To figure that out, this amazing chart is going to be our guide. Seriously, think of this as our map. It plots out 2 decades of the S&P 500's journey, from 2006 all the way to 2026, and it's going to help us see the patterns hiding in plain sight. Now, the secret to reading this map is understanding this one critical line, the 200-day EMA. The easiest way to think about it is like the market's long-term waterline. You know, when the ship is sailing comfortably above it, things are generally looking pretty good. But when it dips below, well, that's when you have to start paying attention. Okay, so first things first, how often does the market even dip below this waterline? Because it turns out not every dip is a reason to panic. The data shows us there are 2 very different kinds of breaks, and knowing the difference is absolutely crucial. So on one hand, you've got what we call sustained breaks. This is the real deal. It's when the market closes below that 200-day line day after day, signaling that a real downturn might be underway. But then you have the false breaks. You might hear people call them whipsaws. This is when the market just briefly dips its toe below the line and then pops right back up. It's basically the market trying to fake you out. So how often does the market truly break? You might be surprised. Looking back over the last 20 years, there have only been 7, just 7, of these major sustained breaks. We're talking about the big ones, the 2008 financial crisis, the COVID crash. You know the names. Now compare that to the number of false alarms. In that exact same period, there were 5 of these whipsaws. 5 different times when the market looked like it was in trouble, but it quickly found its footing and recovered. So here's the key takeaway from all this. When you see the S&P 500 close below that 200-day average, history shows us it's pretty much a coin toss. Out of 12 times it happened, only about half actually turned into a serious long-term downturn. That's definitely not the guaranteed sell everything signal some people think it is. Okay, so let's say we lost that coin toss, and the break turns out to be the real deal. The next big question is, how bad does it get? Let's take a look at the data and see just how far the market can fall. On average, the fall from the peak to the bottom is a gut-wrenching 24%. Oof, that's a significant drop that you definitely feel in your portfolio. But, and this is a huge but, relying on that average can be a really dangerous game. And that quote just nails it, doesn't it? Because an average is just one number, and it smooths over all the chaotic, messy details. When you actually look at the individual downturns, you realize they are anything but average. I mean, just look at this. The 2008 financial crisis was a monster, wiping out more than 50% of the market's value. Then you have the COVID crash in 2020, a brutal, super fast drop of around 34%. And the 2022 dip caused by rate hikes was closer to that average at about 25%. The reason for the fall clearly matters, a lot. All right, enough of the scary stuff. We've talked about the fall, which is painful. But what about the other side of that mountain, the recovery? After the market finally hits bottom, how long does it typically take to climb all the way back up and set a new all-time high? So the average here is about 15 months, a little over a year. That doesn't sound too bad, does it? It seems manageable. But you probably know what I'm going to say. That average number is hiding some wild, wild differences. And here they are. Just look at the insane variation. After the 2008 crisis, it took a grueling 5.5 years to get back to a new peak. But then you have the 2020 crash, where the market recovered in an astonishing 5 months. The context is everything. The massive stimulus after COVID fueled a lightning-fast rebound that just wasn't possible after 2008. So after digging into all this data, how often the market breaks, how deep it falls, and how long the recovery takes, what can we actually take away from it all? What can the patterns of the last 2 decades teach us about navigating the future? Let's just boil it down to 3 key things. First, real sustained market breaks are actually pretty rare, only 7 of them in 20 years. Second, the average fall is a painful 24%, but the real outcome can be way better or a whole lot worse. And third, while the average recovery is about 15 months, the actual timeline can be anything from a few months to over 5 years. And that brings us to the current snapshot in this data set. As of March 2026, the chart shows that the market has entered yet another one of these sustained breaks. Now, we all know history doesn't repeat itself perfectly, but it definitely rhymes. And now we have a historical playbook for the different ways this could unfold.
So I'll leave you with this question to think about. Knowing that a break is a coin toss, that the falls can be deep, but the recoveries can be incredibly swift, how does having this historical perspective change the way you view all the noise and panic in the market today? Thanks for joining me on this deep dive.